Sawadee Krap. It's a great pleasure to be here at the BDFC for 2025 under the theme of building ASEAN Financial Corridor, we're organizing together with our partners, GFTN. It's a particular pleasure to talk on this topic because ASEAN, I think, has made remarkable progress in this area, and it's something that we can be proud of. If you look in the area of digital finance, particularly in payments, I think ASEAN has leapfrogged from many cash-heavy economies, and we've skipped decades of card-based legacy systems and moved directly to digital. If we look around, we see QR codes and mobile wallets are used more widely in ASEAN than in many advanced economies. If we look around the region, in Indonesia, we see that the QRIS now connects over 30 million merchants worldwide. In Malaysia, Do It Now is a nationwide standard. And here in Thailand, PromptPay handles 40+ million transactions daily and reaches over 70% of the population. And this leadership in payments is extended not just domestically, but also to the cross-border area. Thailand is a country where we have about 8 QR code linkages, among the highest, I think, in the world. And ASEAN, happy to say, was one of the first regions in the world to link the real-time payment systems across borders with our Thailand and Singapore PromptPay Pay Now linkage, which is the world's first cross-border fast payment connection. And I'm very glad to see that we're making progress in terms of extending this bilateral linkage onto a multilateral basis through Project Nexus, which is seeing good progress. And hopefully we'll lay the foundations for even greater connectivity, not just within the region, but with places outside the region as well. And what's been particularly, I think, heartening is that this innovation that we've seen in the region is anchored in inclusion. It's really had benefits very in a broad-based way. We think of street vendors in Bangkok and Jakarta, whatever. Think of a shop owner in Manila, whatever. Now, with nothing more than a QR code printed on a piece of paper, they can receive instant payments at little to no cost. And so it's been an innovation which has really helped with inclusion. And I think this inclusivity has been central to ASEAN's approach, that it's not just innovation for the sake of innovating. It's not innovation just to move faster, but it's innovation to bring people along. But this innovation brings challenges. With great progress comes greater challenges and greater risks. Instant payments, as we know, or faster payments leads to faster fraud, something that we are facing challenges, I think, very clearly today, not just in Thailand, but across the region. The cross-border linkages create complex compliance costs and issues related to cross-border AML and CFT. And in terms of inclusion, the more people you get involved into the network, you're exposing less financially and technologically prepared people, the elderly, rural people, to more scams and fraud. So this is the challenge that we face now. How do we continue this progress that we've made? How do we make it sustainable, lasting, and how do we make it more responsible? And for that, I think it's important now to think about a framework for responsible innovation. And when we think about innovation, I think the natural temptation is to see technology as a solution, particularly in an environment like this one where we are today, where we have a lot of fintech firms and innovators. And we think of technology as a solution to a lot of these challenges, making things faster, cheaper, smarter, more convenient, 24/7. But I think history also shows us that technology on its own is not enough, and that for lasting progress, to make this innovation really sustainable, and not sustainable in just the green sense, but sustainable in the lasting and making it enduring and making it responsible, there are at least 3 elements that need to come together. Technology certainly is at the heart of it. It's an absolute must. It's absolutely necessary because it's the enabler of new possibilities. But we also need to make sure that we look at the economic incentives involved to to ensure sustainability, to ensure that what's there is scalable, and to also make sure that it is appropriately inclusive. And also, very importantly, very fundamentally, making sure that there's the right legal and regulatory framework in place, put in guardrails for resilience, and this is a theme I'll come back to, resilience in failure. Okay? Because I think too often we tend to ask the question of, can it work or does it work? Which is a fair question to answer. But we also need to ask the more difficult question, which I don't think we ask ourselves often enough, which is what happens when it doesn't work. And so trying to make sure that what we do, what we put in place, works not just in good times, but also in bad times. So what matters is not just whether the system works in good times, but whether it also holds up when things go wrong. Now, this is coming from a regulator, so you can understand why I'm saying this. Because one thing that we see is that when things go wrong, regulators, central banks are asked to step in. If you look at, for example, the global financial crisis, was situated in 2008, we saw that the financial system back then was built on these sophisticated financial products, which were enabled by advanced technology, which collapsed when trust started to evaporate. And that stability, central banks having to come in and step in and whatnot, was restored not just by technology, but by central bank intervention, by liquidity, providing guarantees, and reestablishing confidence. So I think the lesson from that is the success of any innovation is not what is just celebrated during the normal times, but also to look at its resilience under stress. And I think we as central bankers exist here not just to celebrate smooth functioning, but to ensure that that trust and stability is maintained in crises. So that's a look back to an episode back in 2008. But it also applies, I think, to a lot of the cases and examples that we are looking at today. So a few examples by way of illustration. Digital payments, tokenization, and open data. So let me take digital payments first. The case of PromptPay in Thailand. The technology, again, has been wonderful, and it is delivered on its promise, and it's transformed retail payments in Thailand, again, to a broad mass of people, helped tremendously with inclusion, and it's delivered faster, cheaper, and more accessible payment for all. But it's also clear that technology alone, again, was not sufficient. There's risk. The speed, the low cost, and inclusiveness of PromptPay has also fueled scams and fraud. Fraudsters often call, pretending to be police officers or bank officials, warning victims of suspicious activity, and urging them to transfer money immediately via PromptPay, or their scams regarding fake investment opportunities. Scammers exploit this fear and greed to target the most vulnerable, and they take advantage of the very important features of PromptPay that make PromptPay successful. Its cost and its instant speed, which makes those transfers irreversible once they're sent. So it's clear that what's needed also are the other two elements of that framework that I talked about. You also need the right economic incentives, and you also need the legal and governance framework to accompany this, to make sure that this innovation is responsible, sustainable, and lasting. And we see that fraud prevention cannot rely on technology alone. Banks need liability sharing framework, stronger KYC identity checks, and incentives to cooperate in monitoring suspicious activity rather than shifting blame onto consumers. So the lesson, I think, again, is that fast and cheap is not enough, and that safeguards and shared responsibility are also essential if we want to make digital payments, again, responsible and sustainable. Second example, tokenization, tokenized money. So what the technology promises, again, efficiency, transparency, programmability, smart contracts. Holds tremendous promise, but it also comes again with risks. Stablecoins are based on trust, which can be quite fragile. We've seen, for example, in the Terra Luna collapse in 2022, which wiped out tens of billions of dollars and eroded trust for millions of users. And we've also seen how anonymity can also enable shadow economies and bypass AML and CFT. So the technology is wonderful, it holds tremendous promise, but it needs, again, to be complemented with those two other pillars. So what's needed also, again, right economic incentives and that legal and governance framework to complement it. And money, again, is not just technology. It rests on long-lasting and enduring foundations. As I've spoken in other venues about this, about the future of money, there's certain fundamentals of money which are very important, which important that we do not, through innovation, undermine those foundations because they've served us well. And those foundations are things like money functioning as a unit of account to define value, money acting as a means of payment to enable exchange, and a trusted system of transfer, and very importantly, that preserves the singleness of money. That singleness, the guarantee that all money is exchanged at par, is easily broken if redemption rules are unclear or if confidence starts to evaporate. So that's why these three foundations of money must remain, no matter how the form of it evolves. And I have no doubt that with the technology and tokenization, the form of money will evolve. But we need to make sure that that evolution does not undermine those fundamentals of money, which has made it work so well. So clear redemption rights, disclosure standards, AML CFT safeguards, and aligned incentives are essential to keep that trust that we took so long to build up intact. And so the lesson, I think, in this regard is that we must also, when thinking about tokenized money, prepare for failure scenarios. You know, what happens when a stable coin breaks par, or when confidence suddenly starts to evaporate? And then we need to build those guardrails and that accountability in from the design from day one. Third example, data-driven finance. And there's examples here. Open banking in the UK and what we're trying to do here in Thailand through our initiative called Your Data. And again, the technology has tremendous potential and promise. Secure data sharing platform, expanding consumer choice and competition. But here, common theme, as you can see, there are also reasons to see why technology alone is not sufficient. In Europe, regulators introduced GDPR that gave consumers ownership of their data, and the PSD2 directive that required banks to share data with fintech through secure APIs. But even with these frameworks, many banks resisted sharing, and consumers often struggled with long and complex consent forms that they barely understood. So in Thailand, we're facing the same challenges. We see the same tension. So it's quite clear, that telling consumers alone that the data belongs to them is not enough if they lack the tools, the understanding, and the bargaining power to decide how that data is to be used. So again, that technology needs to be complemented with governance, so rights must be simple, enforceable, and meaningful, and incentives to make participation worthwhile for both banks and fintech, and that consumers also need to have an understanding of how their data is likely to be shared, used, and monetized, and not just in terms of a yes-no consent to a long, complicated form. So again, the lesson is technology can make the data flow, but without clear rules and aligned incentive, adoption stalls, we can't scale this thing, and consumers will remain powerless. So the conclusion, I think, to draw from this is, again, the cases we've seen show a common pattern, that technology is a key enabler, but alone it is not enough. And that for digital finance to be trusted, to be responsible, to be lasting, and inclusive, it needs also to be anchored in sound governance and supported by the right economic incentives. This is the principle behind some of the work that we're doing. So in the Bank of Thailand SAN project, for example, we're testing tokenization for settlement to ensure interoperability across DLT networks and existing infrastructure. The prototype, again, shows good promise, but its real lesson, again, is clear. And the same lesson that I've been repeating throughout, that technology alone is not enough. Without governance, standards, and regional cooperation, the tokenization could create fragmentation rather than reduce it. So our collaboration with the HKMA on this, the Hong Kong Monetary Authority, is one step forward, and we hope that ASEAN can build on that partnership to ensure that that financial corridor is not only fast and innovative, but again, open, interoperable, and trusted. So as we begin here today, 2 days of discussion on a wide variety of topics when I looked at the agenda: AI, quantum computing, tokenization, green finance, and many more. I would like to leave all of us just one question. All of us, and by all of us I mean all of us here, fintech, innovators, banks, regulators. And that question is, oops, they already moved the slide for me. Have we built the governance and incentives to make these technologies serve everyone in both good times and bad? And so with that, let me close by wishing all of you a fruitful 2 days of discussion, and thank you very much for your attention. Khop khun krap.